All right. Hi, everyone. I'm Dr. Stephanie Zhou, and welcome to the second year lecture of the U of T Med Financial Literacy Curriculum, Intro to Investing. This is in the whole context of the financial literacy curriculum. So far in first year, we've covered debt and budgeting, including how the line of credit works and credit scores. So this year, these are some of the topics that we'll cover. And on the screen, you'll see some of the other topics that will be covered in the next couple of years. Just a brief intro about me. So I give the personal finance and practice management lectures to the medical students and residents at the University of Toronto, and I'm also on the financial aid committee. Some of you follow me on Instagram and on YouTube, where I post about personal finance, and I upload my lecture recordings on there as a tool for students. And as part of my day job, I do addiction medicine and family medicine. Now, I'm also on maternity leave, and so I have not gotten any sleep last night because the baby cries almost every 3 hours. So it's like being on call, but every single day. So that is why I've brought in a guest lecturer, Richard Coffin, who completed a Bachelor of Commerce from Carleton University and holds both a CFA and a CFP. He's working as a portfolio manager in Ottawa, and in his spare time, he hosts the Plain Bagel, which is a YouTube channel with videos about finance and investing. And that was how I got introduced to Richard as well. Richard, I'll let you say any disclosures, conflicts of interest.
Sure. Yeah. So I have a few to mention here because I work as a portfolio manager. I'm an employee for an Ottawa firm, WDS Investment Management. That's going to introduce a bias towards the types of investment strategies or solutions I might use would align with the approach my company employs. Steps taken to mitigate this. Naturally, the information we're talking about today, very high level and strictly educational. There's no solicitation of an offering or even an attempt to make any sort of tailored financial advice. Financial advice really does have to meet someone's specific circumstances, and there's no compensation tied to today's lecture. So the intent is to keep things very high level and not to get too into the nitty gritty where those biases might play more of a role. So try to sticking to the information for today's lecture.
Yeah, I don't have any conflicts of interest to disclose. In making the slides, there are some financial products and charts. Those are for demonstration only, not necessarily an endorsement of those products. And I do receive a teaching stipend as part of my role with the faculty. So when I polled students at the universities I teach at, the vast majority of students don't invest, and that is understandable. There's high student debt, there is a cost of living. This makes it hard for a student who is busy studying and not working to have disposable income to invest. But kind of like anything that you learn in med school, whether it be like embryology, anatomy, how to read an x-ray, you'll probably forget it after the exam is over, but you can always refer back to your notes when you actually do need the information. And so this is the same way. You'll remember that, this lecture is on YouTube and you can always go back to it. So by the time you're making disposable income as a resident or attending physician, the earlier you learn the material, the sooner you can get into the market so that you can take advantage of the compound growth. But more on that later. So today, Richard will be making a case for investing and the types of investments. And I'll be touching a bit about the investment accounts, how to purchase investments, and Richard will be sharing his experience on the common ways he's seeing folks lose money. Note that this is not a lecture on picking stocks. We'll be touching more on stocks as a type of investment, but not necessarily on how to pick a certain stock. So I'll pass it on to Richard to talk about what is investing and why it's important to learn, especially after coming out of a weekend where tariffs were announced by the United States. And that has a significant impact for a lot of students, especially students who are wondering, is it going to be more expensive to purchase items? Are my investments going to go down? So I'll let Richard comment on that in his section.
Sure. So, kind of one of the most visible reasons for investing is, as some people know, there's this thing called inflation, which is unfortunate that we have to deal with. where every year prices for goods and services tend to increase, which on the flip side of that decreases the value of money we have. So we have here, for example, $1 in 1990 had the purchasing power of $2.41 today. And certain areas can actually appreciate in value faster or in price faster than other areas. So that's just at the broad level, the inflation we see. Some areas might get even pricier. And when we talk about tariffs, there are areas there that we could see prices increase further because of the protectionism happening there. So investing is one way that people use to combat inflation rather than just putting money aside and having it lose roughly 2% of its value every year. You can invest it and have it grow to try and keep pace with investing. It also helps to achieve financial goals faster than with savings. So when it comes to things like buying a house and retirement, which at times can also be increasing in price, so that's part of it as well, is we want the money we're saving to appreciate so that it can match those growing liabilities. But also it helps to make that a lot more affordable. And we can flip to the next slide for an example of that. So when you compare saving, and I say saving as in just putting money aside without, we'll talk on savings accounts and the like, but assuming you're not earning any sort of return. And if you ignore inflation, even in this circumstance, if you save $500 a month for 40 years, you'll end up with $240,000 of just pure savings. So money that you've put aside on your mattress or whatever. If you instead invest that amount at even just a 6% return, you could see that amount grow to nearly $1 million. So, or roughly 4 times what you had beforehand without investing. So you can see that there, and 6% is sort of a average, moderate to average return there. So even with a moderate to average return, you can see quite the impact by investing your money. And the other reason why investing is so powerful is because of this concept of compounding, which you may or may not have heard before, but many people who are investing enthusiasts will bring this up over and over again. The idea of compounding is interest on interest. So when you earn a return, the amount of money you make the next year is actually greater in dollar terms in year one, because not only is your base savings amount growing or earning that return, but the return you earned last year is also earning a return. So the way I highlight it is if you earn $10 and make a 10% return, next year you get $1. And then the year after it would be, I think, $1.1. So $1.10 roughly, because the amount you're earning from that return is increasing with compounding. And what that means is that over the long term, you can see that simple interest or just adding $10 every year versus compound interest where you earn interest on your interest, you can see a drastic difference between the two. And what that also means is that the earlier you start, the better. The earlier you start investing, the more time you allow compounding to take place, the easier it is to achieve your financial goals, given the money you have. And I have here for an example, if you cut your time horizon from our first example from 40 years to 20 years, you can see that the future amount of money drops from almost $1 million to roughly a quarter of that, $226,000 roughly. So you can see that time in the market and time to allow that compounding plays a really important role with the results we get. So one of the things we have to consider with investing is that there's no such thing as a free lunch, and the way we earn a return is typically by taking on risk, which is why we have this thing called the risk-return trade-off. And it's something that we have to be aware of and to manage ourselves based on our personal situation to match with what we call our risk tolerance. So risk tolerance is the way to view it as your personal ability to take risk with investments and how okay you are with losing certain amounts of money based on the types of investments you take. Generally, 2 components to risk tolerance. There's your ability to take on risk. So that's how old you are. So how long you have until you need the money that you're putting aside. Your time horizon. So how long are you able to invest the money without touching it? And your financial situation. Do you have debts you have to pay off? Do you have a liability that's coming due in 1 year? Those all play a role with your ability to take on risk. Then there's also the more psychological aspect, which is your willingness to take on risk. And that's depending on your experience, your education, and comfort level. And that matters because when markets drop, people tend to have this sort of gut reaction to want to sell investments. And as we'll talk about, staying invested in the long term and kind of riding through the volatility of stock prices tends to be the better approach versus trying to trade off the ups and downs. So part of that is being able to stay invested even when your stress is higher and you're concerned about your investment returns. So that's why we highlight here, it's important to match the risk of your investments to your risk tolerance, because any sort of mismatch might only lead to losses because of riskier investments, but could be result in losses because of your actions based on the risk of your investments and there being a mismatch there. So all things you have to consider at a personal level. Part of that, in terms of how we assess risk tolerance, there's a bunch of different ways to do it. It's quite common for if you go to an advisor at a bank branch and they have to find an appropriate investment for you, they'll often give you a sort of risk tolerance questionnaire of sorts. So this is an example that Stephanie pulled up and was able to show kind of some of the types of areas they look for to gauge how you feel about risk and how your circumstance allows for risk. So things that you can always go and find these resources yourself to take a risk tolerance and get an idea. Or if you go to any service, they'll do this thing. It's part of know your client regulation to understand what your risk tolerance as a client is. So how do we manage risk once we're aware that it exists? There's a number of different ways to do it. One of the key ways is diversification, meaning that it's a common saying of don't put all your eggs in one basket. Each individual investment carries a risk, and we'll talk about the different types of investments. But with stocks, for example, if a company fails, and you could lose your entire investment in a given stock. So diversification helps reduce the risk of your savings or your retirement nest egg being impacted by one company or an idiosyncratic risk kind of tanking the whole portfolio. So diversification is one important way that people manage risk. Asset allocation is another one. We have here, and by asset allocation, we mean how much money into each category of investment someone puts their money into. So generally, the kind of rough rule of thumb is that how much money you put in stock markets, which is on the riskier side of investments. One exercise you can do is take 100 and subtract your age for a rough percentage allocation into equities. Now, it's very rough. You should always base it on your circumstance. Someone who's in their 80s might have a higher risk tolerance than someone in their 20s or 30s. So it's not a perfect rule, but it's just to give you a general idea of how age plays a role with risk tolerance, holding all else constant, and how you can tailor that your portfolio to that risk. And we have an example of a few ETFs, which again, we'll talk about what those are below. But you can see here that they have different breakdowns between the asset allocations. These are called allocation funds. And they give you different types of risk profiles. So the first on the left there, the conservative ETF portfolio would be for lower risk. And you can see that the orange area, which is equity, is smaller than on the far right. We have the growth portfolio, and we have equity taking up 80% of that portfolio. So that's one way that you see people manage the risk, is their asset allocation between the different investment categories.
And I was also going to add that some people, they used to do rebalancing in their portfolio. So they would sell certain portions of equities and buy other portions, for example, of the fixed income, which we'll touch on, as they grow older or as their risk tolerance goes down, for instance. However, with asset allocation funds, also known as all-in-one ETFs, although one example is pictured on the screen, there are multiple others from many other companies as well that do the rebalancing for you. So it makes it very easy to purchase one based on like just one product based on your investor risk tolerance, which we showed in the previous slide. Okay, so I'll move on to the next slide.
Great. So we'll talk about the different types of investment, and we'll generally start from the lower risk investments and what would be held by a more conservative investor, and then move into some of the higher risk and often higher return investments. So cash and cash equivalents, naturally, the safest thing you can do is, well, arguably, if you ignore inflation, is to just hold your money and not invest it at all and not take on any of that investment risk. So cash and cash equivalents generally refers to either holding cash on hand or putting your investment in a very low risk and relatively low return or fairly low return. I have here, for example, 1 to 3%. That can vary. There are kind of macroeconomic factors that determine what that interest rate is, but right now it's kind of between that 1 to 3%, maybe 4% in some cases. Some examples of cash and cash equivalents: you have actual cash. There's guaranteed investment certificates, or GICs, which are very common for beginners. High interest savings accounts, or HISAs, as they're abbreviated. And most of these, especially for GICs and HISAs, they're usually CDIC insured up to $100,000 per depositor per category. So what that means is that if you buy a GIC from a bank, this guaranteed investment certificate, and that bank goes under and is unable to pay you back that amount. In Canada, there's actually this insurance institution that will help pay you back your money up to this amount. And that's $100,000 per different type of fund that you hold. So all to say, it's a very low risk category. Guaranteed investment certificates, they differ from, they're very similar to high interest savings accounts, where you're effectively giving money to a bank so that they can use in their daily operations, and they pay you a low interest rate in return as a sort of reward for letting them do so. With guaranteed investment certificates, that amount is stated and fixed, but the whole time that you have that amount invested in the GIC, you are unable to use it generally. So that means that it's guaranteed, but it's also locked in. Whereas a high interest savings account, the interest rate can vary, but you also have access to the money at any time. So any day that you need the money, you can generally pull it out of a HISA. So these are good for short-term savings without risking your principal, as well as anything like a rainy day fund where you might need it on a very short notice, or your savings for a purchase within a couple of years. Those are all generally appropriate types of things you might want to invest in cash or cash equivalents.
Now, a student might usually ask about, what if I need the money to pay back my tuition when I graduate? Is this a type of investment that you would recommend
Yeah,
for
so it always
tuition
depends,
investing?
but when it comes to short-term obligations, generally, yes, we're going to look to put money that's anywhere from 3 to even up to 5 years, depending on what that liability is. If you have a fixed obligation coming up, then generally it's more appropriate to take this sort of low-risk investment, given that you don't want to put yourself in a worse situation with a fixed obligation. What we find with investments is that generally they can fluctuate quite a bit in the short term. So while we do generally think there's a benefit over the long term, which is why we invest, in any given year, you could easily see, say, a 15 to 20% drop in your money, and you wouldn't want to risk your financial situation or that upcoming purchase or liability to take on that risk. So definitely in that case, that's an example of something that would impact your risk tolerance. You have a very short time frame or time horizon, a fixed obligation. So you would look to put it in an ultra conservative sort of area if you want to have this money put towards that liability.
Yeah. And another question students might ask is about high interest savings account ETFs. Did you want to cover that here or in the ETFs section?
Yeah, we can talk about it briefly. So high interest savings accounts, generally the way they work is you'll have a company with a type of account that you open and you deposit in there, similar to the savings accounts that we all probably have experience with. Some savings accounts, however, they use a different structure called an exchange traded fund, which means that you buy it differently. You buy it similar to the way you buy a stock, which we'll talk about later. But it's effectively the same or similar product. It's just that it's using a different sort of infrastructure or setup to let you invest in it. But it's ultimately the same end thing, which is you're lending money to an institution. They're paying you a low interest rate in return.
Definitely. And it could also be another alternative some students can think about, especially if they're looking to invest for the purpose of paying back their tuition in the
Yeah,
future as well.
exactly. Yeah.
So next up, let's move on to a different type of safer investment, fixed income investments.
Yeah, so fixed income is generally viewed as the tier above cash and cash equivalents, where it's generally still considered low risk and somewhat low return, but there's more risk than with the lowest category there. So fixed income, also you might see the word debt, bonds, notes, debentures. They all generally refer to the same idea, which is that they are a loan that you make to a corporation or a government. So you think of a credit card where you borrow money or spend money, and that comes with an interest rate. This is taking the flip side of that, where instead of using a company's money, you're actually giving them money and they're paying you an interest rate. Unfortunately, they don't pay us credit card rates. They don't pay us 20% on our bonds, and that has something to do with the risk of the investment. You with your credit card are likely a riskier borrower than a company that's borrowing, or the government in some cases that's borrowing money from you. So generally, you could see a return. It could be from 2 or 3% on the low end to 6% on the high end for an investment grade bond. But again, that changes depending on the macroeconomic environment. So you purchase a bond. So quick clarification here. You purchase a bond at the market price. The face value is how much money you get paid back when the bond matures. So similar to a loan, if I give the bank $1,000 at the end of the term of the bond, so let's say it's 10 years, they'll give me $1,000 at the end. That $1,000 is the face or par value. Strangely enough, the price of that bond, if I go and then sell it, could vary from that $1,000. And that's why we have here that bond prices can increase or decrease over time. However, so long as the company remains solvent at the end of the term, or the maturity of the bond, you will get back that $1,000, the face value of the bond. Also, the price movement, because it has that fixed payment, the price movement tends to be less volatile than stocks. So the way, if you have a company that sells both stocks and bonds, generally the bonds will move a lot less than the stocks of that company, and we'll talk about why that exists. And generally speaking, with rising interest rates, bond prices fall. So so if a company issues a 5% paying bond, and let's say it sells for $1,000 initially, and then let's say that the next year they're now selling 6% bonds, the value of that 5% bond is now lower because the same company is now selling bonds at 6%. So that's kind of a general idea of why you see this inverse relationship where as interest rates rise, bond prices fall and vice versa. However, all to say again that if you just hold the bond until maturity, you will get back that face value, the original $1,000 or whatever the amount is, which is why they're considered lower risk. Another kind of side to that is if a company goes bankrupt, those who hold fixed income investments are prioritized over stockholders of the company in trying to pay back. So as a company liquidates or whatever they're doing to try and pay back their creditors, it's those who hold fixed income like the bonds and the like who will get paid back first, and then stocks get paid. So because of that higher priority, they're also considered safer than stocks. Also want to highlight here that there's kind of a category here that some might include in the cash equivalents, which is treasury bills or bonds. This is debt to the government, in fact. So this is money that you give to the government and earn an interest rate on. And because the government theoretically can't go bankrupt, it's considered a very low risk investment and likewise often pays a very low return. But that kind of sits in between the fixed income and the cash equivalents section, given that it is properly a bond. Bill just means a short-term bond. However, it's with the government, so it's considered very low risk.
And often, when would you think about investing in a bond versus something like a GIC, given that they're both, in a way, loans? Um, how do you decide between which?
Yeah, so GICs I often will use if there's a more fixed liability. Part of that is that GICs, so currently anyway, GICs actually offer pretty competitive rates compared to bonds where it's very similar. So if there's a fixed liability, a GIC might be more easier to deal with because you can easily line up your liability with when the GIC is issued. Bonds are a bit more difficult where they tend to be outstanding for 5 to 10 years or longer. It's harder to find bonds for specific companies that line up perfectly with their liabilities. You can do it. However, because the GIC has the guarantee and because the rates are similar, if I know the money's being put aside for a specific liability, I'd often opt for that, given that you're going to earn a similar return. However, if it's a more longer term conservative approach you're taking, I'd likely look to a bond if it's going to be beyond that kind of 3-year threshold.
Exactly. And that's an important point to clarify because for a lot of students, if you're saving up for something that maybe, is in 30 days or maybe it's in 1 year, GICs do tend to have those shorter locked-in
Yep.
periods.
Yeah, but companies don't often issue bonds unless for a longer period of time because of the cost that comes with issuing bonds. So we'll move on to kind of the higher risk, higher reward section of the assets, which is stocks, kind of seen as the bread and butter of the investment industry, kind of the area of focus, given that it tends to have a higher upside to fixed income and cash equivalents compared to a bond where they call it fixed income because the amount of return you earn is fixed. You know how much you'll get so long as everything goes according to plan. With stocks, there's no stated return. However, there's effectively unlimited upside where a company can continually grow. And the way what stocks represent is actual ownership in the company. So if you own one share out of 1 million outstanding shares, that generally will represent 0.0001% of the company. And if you buy one share of Apple, it'll be 0.0000001% of the company because they're so big. However, all to say that shares actually mean that you're a part owner in the company. And that means that if the company does well, your investment does well. If the company does poorly, your investment does poorly. So how do you actually earn money from a stock? Because most people, when they hold a stock, they don't really imagine what it's like to be an owner of a company. But it is very similar to how you would make money from owning a private business. And if you just want to imagine a lemonade stand, that's a very easy way to put it. So let's say you have a stock, 100% stock of lemonade stand. How do you make your money? There's generally two ways. The first is with price appreciation. So you make that lemonade stand more valuable. Generally speaking, the more profitable a company becomes. So every year, if you're able to sell more and more lemonade, you build it out, you build your stand nice and it has a good logo and all that. Or the more promise you have that eventually the company will become more profitable, the higher stock price rises. So if you are able to sell your lemonade stand and people anticipate that demand for lemonade is going to skyrocket, then the value that you're able to sell that lemonade stand for will increase. And typically for younger companies, they'll focus more on that price appreciation aspect where instead of paying out the profits, they'll reinvest it to building out their lemonade stands and making them better and growing faster to price appreciate. The other way you can earn a return from a stock is through a dividend, which is instead of just keeping the money and reinvesting it in their operations, say building out their lemonade stand, they instead just they pay out the profits to their owners. So in that case, you can have a stock that might pay a dividend yield represents how much you earn based on the price of a stock. So if you buy a stock with a 4% dividend yield, that means every year if you invested $100, you'll get roughly $4 a year in shared profit. And that's typical of more older and mature companies where they've already done the growth. They don't really have an opportunity to reinvest. They've already grown their lemonade stand as big as they can. So rather than just trying to grow for no return, they just pay out the profits from their lemonade to their owners. So those are the two ways that you generally earn money from stocks. And as mentioned, you can lose your entire investment, similar to a lemonade stand. If you put $100 in and the next day a fire burns down your stand and all your supply, you've lost all your money. But the returns are uncapped. You could theoretically become the biggest lemonade stand in the world and make a bunch of money. So even though we see stocks and prices and might not understand how that all works, it does all fundamentally fall back to the fact that you're putting money into a business. The investment will succeed if the business succeeds.
Yeah. And next up, we'll talk about alternatives, which is an area where a lot of students and also a lot of practicing doctors will invest into, but it also comes with a lot of risk as well.
Yeah, so alternatives is really just a catch-all phrase for anything that doesn't fall into the typical categories. So that can include private investments. Generally, when we talk about stocks, we're referring to public investments, things that are publicly traded, easy to sell and buy from one trader to another or from one investor to another. Anything private just means like the lemonade stand or a convenience store. A private investment is simply a business that doesn't have a public market where it's easy to make that sale. You have to sell it like you would imagine selling a privately owned business or asset. So there's private equity. Private credit is simply the same thing, but lending to private institutions. There's real estate is considered an alternative investment because of price appreciation and the rents that you can earn from real estate. There's commodities where you buy it on the hope that the price of the commodity will increase. In there, you could also throw in gold, precious metals, where some people invest in it because it used to be used for money, and some people think, and it's still used by financial institutions as a store of value. Derivatives, which can get really complicated, but derivatives are effectively bets on the price of other assets. What they derive their value from a traded stock and the like. So you can have a stock in Apple, for example, and you can have a call option or future based on Apple's price. All that really means is that there are people who don't own the stock who can make bets, and they typically are leveraged on underlying assets. And there's a whole other market around that. It gets really, really advanced at times. And then there's cryptocurrencies, which also would fall into the alternatives bucket as an asset that people buy. Either they treat it like a store of value or they hope that it'll appreciate in value over time as people adopt it further. Generally, alternatives will be considered high risk and higher return. They usually have fewer investor protections compared to publicly traded stocks, which are audited more regularly, have more scrutiny from regulators. Private equity and private credit, it's not uncommon to have a deal come through that you're able to invest in, and then some unknown factor comes up that people hadn't anticipated that might have come up if it was a public institution. And cryptocurrency, of course, we don't have to talk about the risk there, but there's a lot of risk with some of these alternative categories, especially when they're new and emerging. And they typically require a higher degree of expertise because of the more opaque nature of these investments. So they may offer some diversification benefit. The reason many hold alternatives in their portfolio is because their returns might not correlate as directly with stocks. And generally, when you diversify your risk, the less correlated your investments are, the better. Obviously, diversification doesn't do much if your stocks and bonds both fall at the same time. So some use alternatives to try and further spread out their eggs. But generally, they do keep alternatives to a lower percentage of their portfolio, given the risk that's involved with them.
Yeah, and generally I've heard around like less than 5% is what I've kind of seen, but it also kind of depends on how large your portfolio is and how able you are to withstand large falls in your alternative investments as well.
Yeah, it's quite common to have it under 10% or so as like a threshold where you get a bit of exposure if on the chance that these things do well. But because they also require, as mentioned, more expertise and more effort, and because they're higher risk, you don't want to risk your retirement nest egg again
Yeah.
on these sort of types of investments.
And so speaking of diversification, there are some other alternatives that do provide a lot of good diversification if people are looking for that as well. So why don't we touch on some of these managed solutions?
Yeah. So the issue with individual stocks, if you go out and try to buy individual stocks, individual bonds, and even say cryptocurrencies, is that it's very difficult to diversify properly, to build out a full portfolio of, say, 20 to 30 different stocks and the like. It can take a lot of effort, it can take a lot of time, and it takes a good amount of money to build out a properly diversified investment. There's some frictions that come along the way, which is why we have what some call managed solutions, which are effectively a one-stop shop that give you that diversification through one investment. So you're able to buy one product rather than a set of 20 or 30, and that one product itself has a basket of other investments that make it diversified. So generally, these are structured as funds. A fund is simply when a bunch of people get together and pool their money into one fund, and that fund gets managed as if it's one portfolio. And then each individual who invested in that fund gets a share of the return of that fund based on how much they put in. So again, it's a way to get that diversification and simplify the work. It's almost like getting economies of scale just by pooling everyone's money together and managing one account versus all those individual people trying to build their own accounts out. So it's a very effective way to diversify. And you can see here things are kind of scaled from the lowest cost managed solutions out there to the higher cost. On the low end, we have exchange traded funds. These, again, are a pool of assets. They can be bought directly by investors, and they generally have very low MERs. So when we talk about management expense ratio, this is how much you're paying to the administrators of that fund for running it. So when you have a fund, you have a team that deals with the actual movement of money and investment. You have analysts who decide which investments to put the money into. You generally have a portfolio manager. So all those people have labor costs and fees that they charge to run this thing. So the management expense ratio is the percentage that you pay on your investment to cover those costs. So for exchange traded funds, they're one of the lowest MERs available at generally 0.1 to 0.9%. And that's just, it has to do with the structure they use in terms of selling the funds. But as the name implies, they're sold on exchanges in the same way that stocks often trade. Next up is index funds. Index funds can be exchange traded funds. They're kind of sort of a subcategory where they can either be exchange traded funds or mutual funds in terms of structure, but it's a type of fund that sort of supersedes that label. And it's similar, a pool of assets that instead of trying to research investments and determine which ones to put money into, they instead just try to mimic a market or a given index. An index is just a gauge of a market. So we have, for example, the S&P 500, which is 500 of the largest US companies, and it's seen as an index of the US stock market because it'd be very difficult to actually go and invest in every company that exists in the United States. The S&P 500 is a gauge of the market, and S&P 500 index funds simply invest in those 500 companies and give you that exposure. And so index funds, they can take ETF forms. They can also be mutual funds where, as mentioned, they trade at the end of the day versus exchange traded funds, which you can buy and sell at any time during open markets. But it's a type of fund that you can see out there where they take what's called a passive approach. Rather than trying to beat the market, they just buy the market and then you invest in the general growth of the market. Robo-advisors are a different sort of, again, a layer above exchange traded funds. The way a robo-advisor works is it's sort of an automated asset allocation program where you pay a fee, generally 0.5 to 0.8% MER. And then that program will determine what ETFs you hold. So it's almost like a layer. You can either go out and buy your own exchange traded funds, or if you find that to be too much work or you don't want to do the research, a robo-advisor kind of takes away, makes it even easier to diversify and get the exposure that you want. So generally, a robo-advisor will also, you will pay a fee to the robo-advisor, and then they will put your money into exchange traded funds based on your risk your risk questionnaire and things like that. So it's kind of just more of a white glove service, I guess, where it's easier to get started with a robo-advisor in that they kind of do that determination for you. So as mentioned, then we have mutual funds, and these are kind of the traditional fund structure that we have. In Canada, unfortunately, we have some of the highest mutual fund fees in the world. So they're generally viewed as being more expensive. You can see here that their MER compared to ETFs, which are a very similar product, they can be 1% to 2% or even higher. It's not uncommon to see bank mutual funds be 2.5 to 3%. And you have to consider that MER is effectively negative return. So whatever fee you pay when you buy a fund is working against whatever return that investment might be able to earn. So even if you earned 10%, if you pay a 3% fee, your net return is just 7%. So generally, we want to minimize management expense ratios. Now, the benefit of mutual funds is that they're very easy to access, even if you're a very small investor. They're generally sold by advisors. So if you go to your bank branch and you ask for investment advice, generally this is what will happen. You'll see the advisor, they'll advise you on what mutual funds to buy, and they'll help you with that. That can be a benefit in that you get someone to help you with your financial situation and answer your questions. However, they do come with a fee for that. So that fee does typically compensate that advisor for selling you the mutual fund. They also tend to be actively managed because index funds are a lot cheaper and they take a different approach and do that research, which can also contribute to that higher management expense ratio. And there's not often evidence that they do, in fact, beat the market or do better than index funds. So it's tricky to outperform the market, and you're paying a higher fee to try and do so. So kind of some negatives there. But as mentioned, very accessible, and they do come with an advisor, which can benefit people. Then on the very kind of the higher end, if you're a wealthier individual, you can hire a portfolio manager directly rather than doing a fund, meaning that they will in fact go out and build you a tailored portfolio. There are also fee-based advisors, which will be someone who doesn't invest your money for you, but you go to them with your financial information and they put together a plan for you and charge a flat rate or some percentage to do so. So lots of options out there in terms of getting advice or different products that are managed solutions. And it really does depend on the type of situation you find yourself in and how much assistance you're looking for. On the far end, you have, if you have the money for it, hiring a portfolio manager or using a mutual fund if you want an advisor to come with the product. In the middle, you have robo-advisors where it's not a proper advisor where they get to know your situation, but they do give some questionnaires and the like to get to know a bit of your situation and broadly diversify your investment. And then on the do-it-yourself end, you could either build your own portfolio, buy ETFs yourself. You could even buy mutual funds or index funds yourself, and taking that more DIY approach. So lots of options across that spectrum.
Exactly. And when you're deciding on what type of managed solution you're looking for, it might depend on your own budget,
Mm.
especially if you might not be able to pay for like a fee-based advisor, but also it depends on how much how much time you want to spend on managing your own investments as well. So there's always that balance between cost versus time spent. But also there are a lot of DIY solutions that are very simple. Like, for example, some of the asset allocation ETFs we shown on the previous slides, they're also very simple. They may not necessarily take that much time to invest in as well. But
Mm.
the learning on how to purchase investment is on you too. But that's
Yeah.
okay. We'll be covering that in the next couple of slides too.
Yeah. Yeah. The more you take on, the lower you can reduce your fee that you pay for your
Exactly.
investments. So, um,
Now that you kind of know the different types of investments, it's also important to know where to put the investments. So we touched on how some of the investments can have price appreciation, otherwise known as capital gains. Some stocks pay dividends as well. And with any sort of gain from your investments, those can be subject to tax. And so we will be focusing on the tax sheltered accounts in this particular section. So these are kind of like an overview of the different tax sheltered or tax sheltered accounts that we are going to be talking about. And we'll kind of go into each of them in more detail. So that way you can kind of know why perhaps the FHSA might be one of the first accounts you want to think about as a student who might want to look at a home in the future, for example. So let's touch on the TFSA first, or the tax-free savings account. So this is, even though it has the word savings in the name, it's not exactly a savings account. It's better used more as an investing account. The reason why is because a lot of the gains that you have in your tax TFSA are tax-free. So, for example, the higher the gains, the more benefit to you from a tax perspective. And this account starts accumulating room when you start turning 18. And there are a lot of calculators out there that determine, you enter your birth year and it'll determine how much room you have in that account. The other way you can find out is if you go on the CRA personal accounts website, you'll be able to see how much TFSA room you have in that account for yourself. Every January 1st, there will be additional room added. So for example, this year there was $7,000 of room added. And if you don't happen to use the room, like let's say you don't have enough income to put into this account to invest, it always carries over as well. The second account to know about is the RRSP, or Registered Retirement Savings Plan. So kind of in the name, it is a tool for you to save for retirement. It is a tax deferral vehicle. So it's different from the TFSA in that you do pay tax on the gains of your RRSP when you do take that money out, but the tax is deferred to an age where maybe you're not making as much income. Maybe when you're retired, your income tax bracket is lower. So potentially the tax on that income or on those gains might be lower. And we'll use an example later to show you that. The RRSP is also tax deductible. So what that means is that when you put money into your RRSP, it can be deducted against your total income, which can potentially bring you down to a lower tax bracket, which might be valuable, especially if you start earning higher income and putting you into a higher income bracket. So for example, let's say your gross income is $100,000 and your marginal tax rate is 37.9%. The taxes you'll pay on that is about $22,000. However, let's say you make a contribution to your RSP, which is usually 18% of your previous year's income up to a limit. And this limit is determined by the government every year. So for example, this year, it would be 32,000. And so that contribution allows you to make a deduction against your gross income. So that might bring you down to a lower marginal tax rate, and therefore you pay less tax. So it allows you to defer that tax you would have paid, and you can invest that within your RSP for the future. There are two times when you can take money out of your RSP without taxation immediately. So the first is the home buyer's plan. So that is $35,000 for your first home purchase. Can be combined with a partner up to $70,000, but it does have to be repaid in 15 years. Then there's also the lifelong learning plan, which if you are looking to, update your education, update your credentials, you can take out $20,000 for that, but it also has to be repaid, but in 10 years. The reason I want to touch on these two accounts first is because to understand these two accounts, it'll help you understand this first home savings account, or the FHSA, which is a new account that started in April 1st of 2023. And so particularly for the student audience, some of them might want to own a home in the future. It's an account that helps you save for your first home down payment. And how it works is it kind of combines the best of the TFSA and the RRSP. So just like the TFSA, where the gains within the FHSA grow tax-free, and also just like the RRSP, you can make deductions and therefore defer tax on gains until potentially retirement or until whenever you're in a lower tax bracket. So to kind of understand those two aspects, it helps you understand what the FHSA does. The maximum contribution limit of the FHSA is $40,000. And different from the TFSA is that this room starts not necessarily when you're turning 18. It starts when you open the account. So you could open the account at age 18, or you can open the account at any age, but the sooner the better, because every year you get $8,000 of contribution room up to that $40,000. And if you have a spouse who also has never owned a home before, you can combine that together for a bigger size down payment. Similar to the TFSA, for example, the tax deductions, similar to an RSP, the tax deductions can be carried forward, but you have to kind of use that account or withdraw the money in the account for your home in 15 years. If not, it gets rolled into your RSP, which can also be a benefit too, because it increases the room in your RSP as well. Let's say in 1 year, you don't have $8,000 to contribute. You contribute only $5,000 instead. Well, the next year, when you do have some extra, you can add that to the $8,000 of the contribution room you get in the second year. But if you over contribute, then you will get taxed at a pretty hefty amount of 1% per month. So you always want to try to keep track of your contributions and make sure you're not over contributing. So because of a lot of details that come with both these accounts, the TFSA and the FHSA, I do have two separate lectures I did specifically on them, and I'll link these in the description below so you can access them for more information when it does come time for you to put your investments into these accounts, should these accounts be what you decide to put your investments in. I'll touch on this briefly, just for those in the audience who do have kids. There is another account called the RESP for those who want to save up for your kids' future education, or for potentially your other family members' kids, for instance. You can help them with their RESP as well by giving some money to their parents, for instance. So basically, for this account, the maximum amount of room you have in total is $50,000. And kind of like the RRSP, it gets taxed if the money comes out in your child's hands, which might not be very much tax, because how much is an 18-year-old or a college-age student really earning? So the benefit of this account is whatever money you put in, for example, let's say you contribute $2,500 per year, the government will contribute or match the 20% up to $500 of that $2,500 per year. So a common question a lot of students will have is, do I just put money into these accounts and just leave it there? So not necessarily. Think of all of these accounts like a pot. When you open these accounts at either banks or online brokerages, and you put money into these accounts, it's kind of like just putting dirt into a pot. It doesn't really grow anything. So these accounts just hold your investments. So that's why you have to, within the pot of the FHSA, TFSAs, and so on, you would then purchase investments, such as the investment types that we touched on in the previous slide. And then by purchasing these investments, they will grow and compound your money within these pots. And then therefore will be subject to the tax treatment or the lack of tax treatment within these accounts as well. So now that we touch on the different types of accounts, the different types of investments, the next thing you have to know is, okay, now I'm ready to purchase an investment. So once you've opened one of those investment accounts and you've kind of decided, how many stocks versus ETFs or versus bonds and GICs you want to purchase, how do you actually go about buying an investment? There are two ways to go about doing it. The first, you can either consider an advisor. So, advisors we touched on earlier, they can be found at banks, they could be found at some of the brokerages, for instance, and they do charge that MER, which touched on. There are also brokerages that are more geared towards DIY investors, for instance, and you can purchase an investment using these brokerages on your own as well. There are some that charge amount per trade, for instance. They might charge an account fee, but there are also other ones out there that are zero commission as well. So for example, they might not charge you anything to purchase an ETF, or they might not charge you anything to make a trade. To prevent talking about specific products, you can easily go on Google and find zero commission brokerages or free trading brokerages out there as well. So the logistics of making a trade. So this is what a typical trading platform might look like and the very basics of what you have to know. So let's say you decide on like a stock that you want to invest in. For this example, we just used Apple. You have to know what the ticker symbol is, or you can just type in the particular company that you're looking to buy, the particular ETF you're looking to invest in, for instance. So when you put in that ticker symbol, it'll pull up something called the bid and the ask price. So the bid price is the highest price someone is willing to pay for that. And you'll see next to it the bid size, which is how much quantity is currently being traded at that particular price. There is also something called an ask price, which is how much a seller is willing to sell their shares of Apple to whoever is the buyer making the bid. And there's also an ask size, the quantity someone will sell at that price. Sometimes you don't necessarily see the bid size and the ask size being equal. Sometimes there might be more sellers than there are actually buyers. And so you might see a little bit of a difference there as well. When you decide how much you want to buy, it depends on how much money you're looking to invest. So let's say you're looking to invest $10,000. You would then divide that by either the ask price or maybe a little bit lower than the ask price. And I'll touch on that a bit later. And whatever amount you get will be the number of shares that $10,000 can purchase. And so that might help you determine the quantity you can purchase because if you only had $10,000 and you wanted to invest in an Apple, you may not necessarily be able to afford 100 shares of Apple. So you have to decide for yourself how many quantity of Apple you want to purchase. Then you would put in something called an order type. And the two main ones you should know about is limit order and market order. So I'll touch on market order first. Market order is basically just what, the market is selling the price at. So for example, in this case, $238, it'll just be that whatever current available price that it's selling at. But let's say that you feel like the stock might drop a little bit, or you feel like the asking price is not what you want to pay for it. You might put in a limit order and you might put maybe if you want to buy Apple at a slightly lower price, you might put in a slightly lower price, like $237 instead of $238. And if the share of Apple falls to that price and enough people are willing to sell at that price you want, then your limit order would fill. However, I guess, risk with limit orders is that, it depends on when that stock hits the price, then it will fill. If it doesn't, then it may not fill. So that's where the next thing is the duration. So if you want your limit order to be active for a certain time frame, then that's where the duration would be in effect. So for example, you might put days. So at the end of the trading day, if it doesn't reach the price you want for that share, then it just cancels the order. But there's different types of durations, depending on how long you want your order to be active for. But in this example, we generally put 1 day. There is also another thing that you might notice is called stop loss. And this might be important to know about is if, you bought an investment and you're worried that that investment price might drop very significantly in the future. If you put in a stop loss, once it reaches that price that you are uncomfortable for the stock to drop even further, then it'll trigger a sale, which can help limit your losses as well. But then again, this may not apply to everybody. I just included that information there for comprehensiveness. Okay, so next up, now that we touched on how to make a trade, Richard, do you want to talk about, based on your experience, what are some pitfalls that people have fallen into when it comes to making investments?
Sure. Yeah. So when it comes to investing, naturally there's numbers involved with it, but many call it almost an art form, which means that figuring out what to invest in takes nothing more like there's no way to get good at it without experience and practice, which is why it's worth talking about these common pitfalls, because oftentimes people in trying to learn the process of investing fall for these very common things. For one, it's worth highlighting the difference between investing and trading. Often it has to do with the time frame that you're looking at. Generally, when we talk about investing, we're looking at a long-term strategy. So what that means is that we're looking to buy and hold an investment with less focus on the day-to-day fluctuations of the stock's price, caring more about the underlying business and its fundamental potential versus the fact that it jumped or fell $5 on a given day. Generally speaking, if you do it properly, in the sense that you aren't just speculating or buying companies without research, holding for a longer period of time is viewed as being less risky than trading, given that's not as impacted by market fluctuations. And over the long term, the stock market has generally appreciated in value. So while there are examples where, for example, you might have sold an investment if you traded because it was falling in value and maybe that saved you money versus a long-term strategy, on the balance, holding all those constant, it's usually a better idea to focus on long-term investing, given that markets can fluctuate very quickly on a day-to-day basis. And given your human emotions and the like, that can lead to poor investing decision or trading decisions. Trading, on the other hand, again, generally viewed as a short-term strategy. You might hear terms like day trading or swing trading. Those are strategies people use where instead of caring too much about the fundamentals of the business, they instead just trade off of price movement and momentum. So they buy a stock based on what they think the price will move in the next day or two. And then sell accordingly. And a lot of the research has more to do with technical research, meaning you're analyzing price charts versus the actual business. And it's a much more active approach. It can profit from market fluctuations, but it's very high risk. It takes a lot more time, expertise, and research. And there's not a crazy amount of research to support the idea that day trading, especially, is profitable. Something like over 90% of day traders lose money trading stocks. So it can be a very dangerous kind of area to focus on, which is why we often highlight investing as a more appropriate approach. Another kind of common pitfall in line with trading, but also sometimes people fall for it when they take that longer term approach, is buying based off of headlines, meaning that you see in the news that, let's say, Apple just announced a brand new iPhone or different product line, let's say, that might be a new promising source of return. And that leads you to go and buy Apple stock because you think, oh, wow, they have this new product. It's going to do well. The issue with taking that approach is that markets are forward looking and they're very quick to adapt to headlines, meaning that by the time you've read a news headline about a company, there have already been financial firms and institutions who have traded based on that new price and adapted their price. So if you buy a stock based on the headline, you're paying a higher price than what you would have before the headline was published because it's already priced in. People who are selling the stock will no longer sell for a lower price because the seller is also aware of that headline. So unless you have information that the sellers aren't aware of, you're not going to be able to find a deal or a steal just trading off of headlines. Again, because the market is very quick to adapt. There's also things like you can see that companies like GameStop, where people focus more on the headlines, and that sort of day-to-day trading is a lot more volatile. So it's very easy to buy in at the wrong time. A lot of people were talking about GameStop in January of 2021, which is right at the peak that it was at. So buying into GameStop right when you've heard about all the hoopla about it and you bought in during all the hype. Again, you can see that that's already priced in at that point. People already know about it, and by the time you find out, it might already have been priced in and might not turn out as expected. Another one is sort of similar with the headline investing. You should never buy an investment just based off of one or two headlines. And another in line with that is investing without proper research. It's very common for people when they start investing to buy based off of headlines or individual points of data. But stock analysis, as I can attest to, is a full-time job, meaning that it can take quite some time to do enough research to justify buying or selling an investment. There's a lot of stuff you have to look into: the balance sheet, the income statements, other financial statements, and the filings. You have to understand a business in the same way you would understand a private business. So while you might focus on prices and headlines, when you buy an investment, you have to understand that you are buying a business. And in the same way you would want to understand everything about a convenience store that you were, say, buying privately, you want to understand everything about the public companies. And that takes a lot of work and research. So we can see, I've talked about this myself in the past, my own research process online. And there are a lot of videos that show you if you want to learn more about the process, but it is a full-time effort and it takes even education. Often highlight, if you don't know what the terms depreciation, capitalization, and capital expenditures mean, then you have a lot more work to do before you do stock research. And quite frankly, if you want to go down the path of doing your own stock research, I think an accounting course goes a long way. It might not be the most fun you do, but it's definitely an important part to read the language of these companies. So all to say that there's a lot of work that goes into research, and it's never as simple as one headline or one piece of information. You really do have to have a comprehensive view of the business, just as you would want to have if you were to, again, go and buy a private business.
Yeah, and it can be tough for students to find the time to do this type
Mm.
of research. So then again, it's also a balance between, how much time do you have to dedicate to this, versus, how much returns will you actually get out of that as well.
Yeah. Yeah. Which is where those managed solutions come in, as well as even without an advisor, you can DIY without doing your own research
Yeah,
if you
with
take a
like the
more passive or
ETFs.
index fund. Yeah.
Yeah.
The other thing is not knowing the risks of leveraged investing. So I'm familiar that many students might, for example, have a loan or the like that they start investing with because they don't necessarily need it up front for their expenses. And then when that loan comes due, they realize their investments have dropped in value. So even though leverage investing, meaning that you borrow money and then invest with the borrowed money, that can lead to higher returns since you are investing with money that you yourself aren't putting any capital up front. And if you earn a return, then you basically get a free return. It also amplifies your downside as well. So it amplifies both sides of the equation. And that lower downside really adds to your risk, which might not be appropriate, especially if you're a student with that fixed liability coming up. So we talked earlier about how someone with a fixed liability has a lower risk tolerance. So if you take that fixed liability and you also do leverage trading, you're really increasing the disparity between your risk tolerance and your the risk you're taking on with your investments. On top of that, there are types of debt people might use to invest, like lines of credit, and they are callable, meaning that let's say you borrow money from a line of credit, you invest that money, and then the market falls. On that same day, the bank might call you and have you return the money you've borrowed, meaning you have to take that loss. You can't time it better or try to wait for markets to rebound. So a lot of risks involved with leveraged investing, generally seen as a high risk and certainly one that requires a more expertise type of approach. So might probably not appropriate for most beginners, certainly.
Yeah, and here in the financial aid office, we had a lot of students come because, well, not a lot, but there were some students that came who invested their line of credit as the interest rates were rising really quickly. And so now they were needing to pay more per month for their line of credit, but their investments were dropping the other direction. And so they were really panicking about that as well. So if you are worried that you're going to end up in that situation, then we don't really recommend investing your line of credit.
And kind of one of the last ones here is treating off of gut feelings and emotions. Unfortunately, human brains are not designed well to deal with money and investing and the fluctuating market price. And it's very easy to succumb to feelings of regret or anxiety over dropping market prices rather than focusing on the information and whether something fundamentally makes sense or not. And there's this great quote by Benjamin Graham, who, if you aren't aware, is the guy who actually taught Warren Buffett how to invest. And the quote goes, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." And what that means is the market price of an investment fluctuates on the daily, often because of sentiment rather than actual fundamental changes in the business. And likewise, it's important to keep that in mind when you're investing in yourself. You don't want to sell or buy based on the voting machine, say buying whenever the voting machine says this investment is good and selling whenever it says it's bad. It's better to buy and wait for the weighing machine to take part.
And I think that quote came from The Intelligent Investor, which
Probably, yeah,
is
that wouldn't surprise me, which is his book. Yeah.
yeah, which is one of the books that we could you could suggest we could suggest you read as well,
Mm,
which kind of brings us to the final quote: "Doing well with money has little to do with how smart you are, but rather how you behave as well."
mm.
And this one's from a different book called The Psychology of Money. So that brings us to the resources section. And both Richard and I put together some resources that, should you want to learn more in the future, as, one lecture may not be enough for you to really understand the full complexity of investing. We're going to give you some resources following this. So if you are on social media and you want to learn more passively about finances, about investing, I'm on Instagram, and the lecturers after me, Doctors Jane and Paul Healy, are on the Physicians Financial Independence Facebook group. And you can go on there and ask some of your colleagues, older physicians, questions as well. Another very passive way of learning, Reddit. Although, these are all anonymous people, so maybe the advice may not be all that great. Some of them might be great, some of them might not be, but it's kind of like a way to just kind of get you interested in some of the topics by reading about it, hearing about it. Both Richard and I are on YouTube, and I've featured Richard's channel on my channel as well as a resource section for students, amongst others. So in addition to Richard's channel, he also has recommended 𝗧cie, a different channel, which I've added into the featured section, as well as 𝗧cie_𝗬𝗀𝘀, who I think he's like a prof at NYU. Is that
That's right.
correct?
Yep. Yeah,
Yeah, so
both are US based. So you have to
US
consider
based.
that
Yeah,
things like TFSAs and RSPs are not US types of accounts, but
exactly.
in terms of high level investment strategy and financial habits and the like, two great channels. Yeah.
Yeah, I would say the 2 cents channel tends to be more geared towards beginner level
Yeah, more
compared to
personal finance. Yeah.
Aswat's channels. Okay.
Yeah.
And then just in terms of books, for myself, I made a video just recommending 5 Canadian personal finance books, covering a variety of topics from ETFs to very basic personal finance to real estate to retirement. So it was very general, 5 books that I recommended. And then Richard recommended these 3 books that I've linked down below as well. So A Random Walk Down Wall Street, The Wealthy Barber Returns, and The Psychology of Money. Anything you wanted to add about these books, Richard?
Well, so they all cover slightly different things. The Wealthy Barber Returns is definitely more of a beginner friendly of probably the most beginner friendly of the three and focuses more on Canadian financial accounts and the like and spending habits. So more of a personal finance intro type book. A Random Walk Down Wall Street is more focused specifically on investing, and talks about how difficult it is to do research and gives very practical steps to getting started with investing. A very highly regarded book in the industry. And The Psychology of Money is, as the name kind of implies, the different biases and habits we have with money and teaches you about the shortcomings our brains have psychologically when trying to make investment and trading and financial decisions. And being aware of that helps you in dealing with them and gives you strategies for trying to deal with that stuff. So 3 books on kind of different areas of finance, but all really good reads and really
For
helpful.
sure. And I'll link those in the description as well. And then finally, more for a physician audience. If you are interested in doing more of like a workshop, seminar type based, I guess, event that is philanthropic, but also, you know, organized by your fellow physician colleagues, your resident colleagues, and medical student colleagues. The Physicians Financial Wellness Conference takes place in November every year, which is Financial Literacy Month. And the proceeds from this conference does go to the Equity Award, which is a needs-based scholarship for a student of financial need in the graduating class. So when you guys are in 4th year, this is an award that you can apply to as well. So if you have any questions, feel free to reach out to me or leave a comment. And I put these pictures here because for a lot of you, you might feel very overwhelmed with all the information we covered today, but there is a lot to learn and everyone starts somewhere in their investing journey. So thank you for attending today's class. And if there's ever any questions, feel free to reach out and check out some of the resources we've highlighted.